Welcome to Money Talk. I'm Kim Parlee. The transition to a lower carbon economy is well on its way. It's having some interesting impacts on all sorts of different economies. One way to incentivize polluters to lower their greenhouse gas emissions is to put a cost on it, put a price on carbon. And now there is an ETF that tracks the price of carbon credits. With more on this is Michael Craig, Head of Asset Allocation at TD Asset Management, and Hussein Allidina, Head of Commodities at TD Asset Management. They are co-portfolio managers of the TD Global Carbon Credit Index ETF, ticker TCBN, which was launched today on the TSX. That was a lot. That was a lot I had to get out. It's great to have you both here.
Thank you for having us.
Let's start. I want to get into the details of the ETF and how it works. But just before we get there, I mean, I haven't spoken to you in a bit in terms of just the markets. In 30 seconds or less, I mean, what are you seeing right now as we kind of get through the summer and start getting into the fall?
Well, the market's got kind of a bag of rocks last Friday from Jackson Hole. Powell told the world, and I think central banks will follow, that rates are going higher and are going to stay there for a while. And that has spooked the equity markets. Equity markets are down about 5 to 6% since then. So we're going to have a tight, elevated period of higher rates. Markets aren't going to like it. Consumers aren't going to like that. And I think we're going to have a very volatile fall market, particularly in equities, as people come back from the cottage and reassess where we stand.
Not fun. All right, but one of the interesting things about what we're going to talk about too, I think, is maybe the offset something like this might have with the market over the next little while too. But let's talk a bit about the again, the TD Global Carbon Credit Index ETF. The two of you were actually at the TMX this morning, opening the markets. There you are. I just look pretty happy about this, pretty exciting that it happened. Hussein, can I start with you? Just maybe, can you explain what carbon credits are and how the carbon credit market works?
Yeah, for sure. So there's a couple of different ways that we can price carbon. In Canada, as an example, we have a carbon tax. That is not what we're talking about in this ETF. Other markets like Europe, like California, like the northeast of the US, the RGGI market, they have a cap and trade system. And broadly speaking, the way it works is that industry that is covered by this regulation has to buy credits to offset their emissions. One credit, broadly speaking, is a ton of carbon. Every year in Europe, if you're a covered entity, you have to submit a carbon credit, which you are either allocated or you buy in the open market to offset the emissions of the prior year. In Europe in particular, you know, you're a refiner, I'm a refiner. We're both issued an allocation. You happen to be a cleaner operator than I am, and as a result, you have excess credits that you can go into the market and sell. I, being the dirtier operator, need to go into the market and buy those credits. If I don't have those credits, I'm fined on a daily basis, a pretty exorbitant amount, and effectively, that structure allows there to be a price on carbon, which is set by the market, not by a regulatory body or the government. The market dictates where the carbon price is. Ultimately, the carbon price needs to go to a level to discourage you and I from emitting.
Yeah. You mentioned refiners as an example, and so I'm assuming that's one kind of company, but what are the kinds of companies, the industries that are doing the most on this? Like, who needs to deal with this the most?
Yeah, so it's a very good question. So first, if we look at globally how much of emissions are priced, 10 years ago, about 5% of the world's emissions were subject to some form of either carbon price or cap and trade. Today, that number is just shy of 25%. And as we move forward, anticipate that number grows as more countries, economies put a carbon price in place. Specifically, the industries that are covered, if we look at Europe, where our ETF today is focused, about 36% of Europe's emissions are covered by this cap and trade program. And within the economy, it's the more polluting sectors that are being targeted. So we think about industrial metals, pulp and paper, refining, power generation, aviation, and that sort of coverage universe will grow through time, and you'll add more covered industries into it.
I want to come back to this, but before we do, just what is this ETF designed to do?
So early days, we'll track the price of carbon in Europe. Europe's the deepest market right now, the most liquid, and in terms of investors, it offers us the most liquidity and least amount of frictions to establish a position. Over time, with, you know, Hussein mentioned the Northeast, California, UK, et cetera, other markets will evolve, and we would expect that to be brought into this ETF. But for now, in terms of liquidity, that's the market we'll follow. These are early days. But we see this as a very, very prudent system to reduce carbon over the long term, and wanted to make sure that we had an investment vehicle to be able to use that within our accounts.
It's an interesting time to be launching this as well. As you mentioned, it's early days. And you mentioned what's going to drive the pricing of these carbon credits is demand and supply, but maybe tell us a bit more about that.
Yeah.
Because, anyways, yeah, please go ahead.
So in Europe, again, we're going back to my refinery example, we are allocated credits. Now, the free allocation that we get is decreasing through time by design, by regulation. So right now it decreases by roughly, total emissions are mandated to decrease by about 2% and change every year. There is some discussion to lift that, but ultimately the allocation of credits decreases. Unless our demand for those credits, i.e. our emissions decrease, the market's in deficit. And ultimately, that is why we're constructive on carbon prices, because by mandate, the amount of allocation that moves into the system is decreasing.
And I guess, so much of this is going to be driven as well by just, if we get back to growth again, I mean, I'm thinking years out from now as opposed to right now, that's going to be, with growth comes emissions, which comes the need for the credits too. But carbon prices, I understand, are more firm in Europe, but they've been volatile we've seen volatility in lots of other asset classes. You expect that, do you expect to see some more volatility in this type of thing, or?
So carbon prices are volatile relative to your traditional equities, fixed income assets. I think what is surprising about carbon, if you'd asked me 12 months ago, Europe is moving into recession, will carbon prices be higher or lower? My prior would be that carbon prices, because economic growth is lower, would be lower.
Right.
Ultimately, though, what you're seeing happen in Europe, because of the shortage in natural gas, you're seeing dirtier fuels, frankly, coal, as an example, generation pick up. So the demand for carbon credits is increasing, and prices have held relatively firm. Today, we're trading north of about 80 euros a ton. At the high, we were just shy of 100 euros a ton. They have sold off a little bit over the course of the last week and a half, as concerns about what Europe might do with the program have grown, and that's why you've seen a bit of weakness. But broadly speaking, carbon prices have outperformed, equities, fixed income.
Year to date, bonds, equities both down double digits, metals down double digits. Carbon is up about 2 or 3% year to date. So it's actually, there's been a lot of volatility, but on the year, it's actually been okay.
Yeah.
And again, it's by design, right? No one wants to see carbon credits kind of race off to the moon like energy prices have been in Europe, and certainly don't want them lower. So there is incentive to have some stability, but it is a volatile asset class, but one that very much behaves on its own kind of candor. It does not have a lot of relationship to bonds or equities.
Which is nice, that counter-cyclicality in this kind of market. We've only had about 15 seconds though, but price forecast, do you dare do it? You said you're around 80 euros a ton right now. Where do you see it going?
So we don't have an official price forecast, but if you look at what academics, the World Bank, the UN, others have said, if we have any hope of reaching our climate objectives, Paris 2030, prices need to be north of $100 US dollars a ton. That is kind of the consensus on where we need to go. There's other groups that have forecasted materially higher prices. If you look at the supply and demand in Europe for carbon, you need to have materially weaker growth, i.e. materially lower carbon emissions, in order to not be in deficit. So that portends to higher prices in our view.
We touched a little bit on this about just the construction, how the carbon credit market works, but I want to ask the question that people are care probably the most about when they're watching is, why would I put a carbon ETF into my portfolio right now? And I will tell people, do your own research, do what's good for you, but from your perspective.
So there's first two characteristics about this. A, it's volatile, more volatile than stocks and bonds, but B, it does tend to operate on its own axis. It's very uncorrelated. So anytime as a multi-asset allocator, you can find an investment that you think is going to go higher and has a very low correlation to what you hold, it's interesting. So from a diversification perspective, it's quite intriguing. Secondly, more and more companies are going to be covered by this trading protocol. And that's going to hit either revenues or earnings. So either, as a company, you have a new expense, you either pass it on to your customers and you get lower profits, or you eat it and you have lower margins. This is a way to hedge that in a portfolio, such that if the price of carbon goes higher, and maybe you own some oil companies and those prices are hit a bit, you offset that through the carbon ETF. So that's kind of it. There's a diversification and a hedging aspect. And ultimately, look, I grew up on the West Coast. I never heard the term atmospheric flood in the 30 years I lived there, and in November they had 3 of them.
Yeah.
Half of Pakistan right now is underwater. The world is changing, climate change is real, and we need real kind of solutions for it. And I think this kind of mechanism is one I think that aligns industry and consumers. Look, we've got to make some decisions. We have to innovate or consume less. and we have to do it now. And so that's what I think is quite interesting about this solution.
It is, and I'm curious though, from a risk standpoint, when you look at this, it's you can see the growth, and just it's very clear, and the fact that it's negative correlated. But I think it's also highly regulated, which means it could be political. We're in an inflationary environment. This adds a cost. So maybe what are the risks that people have to think about?
Yeah. So I think when you think about carbon and the demand for credits, growth is obviously a big one. So if we have weak economic growth, we have less output, we have less carbon emissions, and that's a risk. There is a tail risk that because the market is dependent on regulation, the reason that you have the EU ETS is because the European government came together and said, look, this is the amount of allocation we're going to afford, and this is how it's going to evolve over time. You could see a pause or a suspension of the program on the heels of the elevated energy prices that you're seeing. But for context, Kim, I think it's important, European carbon price is $80 a ton. Even if you get rid of it entirely, it does not fix the energy problem. Arguably makes the energy problem worse because you need to transition because of the issues Mike's talked about. But I think the biggest risk is we wake up tomorrow morning or next week and Europe says, look, we're putting a hold on the program.
Last question, and you touched on this as well too, but just from an asset allocation point, this is all about no correlation. This is the thing that's attractive for people to think about as they're building their portfolios to make sure they can withstand what's happening in the markets.
100%, yeah, 100%. We did a lot of work on this. I wouldn't advise this much, but you get to a point where, there's actually a fairly sizable allocation, and you still actually get to a portfolio with better risk and return characteristics now. And so the point is we put it the math and meat grinder, you actually get to a pretty interesting allocation without even knowing anything about the asset class, just looking at its risk and return characteristics. So I think it's been an interesting day. It's not often you're involved in like launching of a brand new asset class, which this pretty much is. Yeah. And the wonderful thing is it is very much, it does improve the portfolio dynamics that we would otherwise have.